On April 9, Meta committed $21 billion to CoreWeave for AI cloud capacity through 2032. The same day, Palantir fell 7.3%. Both companies carry the AI label. Both trade on the Nasdaq. The S&P 500 rose 0.62%, and the Nasdaq added 0.83%. A day the headlines described as a broad AI rally. It was not broad, it was a split. CoreWeave closed at $92, up 3.49%, on volume running 149% above its 3-month average. Marvell Technology rose nearly 5% after Barclays highlighted underappreciated value in its optical interconnect components, the physical pipes that move data between AI chips. Amazon surged 5.4% after CEO Andy Jassy's shareholder letter detailed the company's AI infrastructure and AWS expansion plans. Intel added 4.7% on an expanded Google Cloud AI partnership. In the same session, Palantir dropped on investor Michael Burry's warning about rising competition from Anthropic, with trading volume running 82% above average, the kind of volume that marks institutional repositioning, not retail noise. Salesforce and ServiceNow extended a slide that has already erased hundreds of billions in software market capitalization this year. Cloudflare and Snowflake declined in sympathy. The Benzinga headline used the word SaaS spocalypse. That is a word people use when something structural appears to be happening. The surface reading of April 9 is that AI sentiment lifted technology stocks. The actual reading is that it lifted one layer of AI and punished another. The bifurcation has a causal path that runs directly through Anthropic. Earlier this year, Anthropic launched Claude Cowork plugins, horizontal AI agents capable of performing tasks that legacy software platforms charge subscription fees to handle. The fear is not that AI will destroy enterprise software. The fear is that AI will commoditize it. If an AI agent can draft the Salesforce workflow, populate the ServiceNow ticket, and generate the Snowflake query, the premium that SaaS companies charge for doing those things becomes negotiable. Double-digit year-to-date declines at Salesforce and ServiceNow are pricing that negotiation in. But the same dynamic that threatens application layer software is a direct accelerant for compute layer infrastructure. Every AI agent, whether it runs on Anthropic's Claude, Meta's Llama, or Google's Gemini, needs GPU clusters, networking, and data center capacity. Meta's $21 billion commitment to CoreWeave is not a bet on one AI model. It is a bet that AI workloads will keep growing regardless of which software platform wins or loses. CoreWeave does not care whether Salesforce survives. It needs Meta to keep training. Marvell's optical components business tells the same story at a smaller scale. Barclays raised its price target specifically because optical interconnects, the cables that link GPU to GPU inside data centers, become more valuable as cluster sizes scale. The physical substrate gets more expensive as the AI software layer gets cheaper. That is not a coincidence. It is the same trade, expressed in two different tickers. Amazon's position is more complex. AWS is both a cloud infrastructure provider and an application layer competitor to enterprise software. Jassy's shareholder letter positioned Amazon squarely on the infrastructure side, emphasizing GPU capacity and custom AI chips. The market rewarded that framing. The winner swap between AI infrastructure and AI software has been building since the start of 2026, but April 9 is the first session where both sides moved sharply in opposite directions on the same catalyst, Meta's CoreWeave commitment. That simultaneity matters. It suggests the market is no longer treating AI as a single trade. It is treating it as two trades that happen to share a label. The durability of the split depends on one condition: whether AI agents actually displace SaaS revenue, or whether they turn out to be incremental add-ons that expand the market. The bull case for Salesforce and ServiceNow is that enterprise customers buy AI on top of existing platforms, not instead of them. Wedbush made exactly that argument on April 9, calling the ServiceNow and Salesforce sell-offs disconnected from fundamentals. That reading is possible. Enterprise software has survived disruption threats before, and both companies have their own AI roadmaps. But the bear case is that the Anthropic Cowork launch is a tell. If a third-party AI agent can perform core SaaS functions, the economic logic for vertically integrated SaaS pricing weakens. The 2010s analog is instructive. Mobile did not kill desktop enterprise software, but it compressed pricing power and forced bundling strategies that hurt margins for years. The Anthropic threat may not need to destroy Salesforce to damage it. The benchmark to watch is CoreWeave's next earnings report, expected within the next 60 days, alongside Salesforce's Q1 guidance update. If CoreWeave sustains triple-digit revenue growth, while Salesforce revises guidance lower, the split becomes a structural rotation, not a one-day divergence. If Salesforce holds guidance and Wedbush is proved right, the April 9th move looks like overcorrection. The weight of evidence today, $21 billion to compute. Barry warning on software. SaaS volume running hot to the downside, leans toward the split deepening. But it leans, it does not confirm. The next 60 days will say which side of this trade was right.